Old Mutual said its plans to go four ways would free the company from structural costs and constraints. In a message on the Old Mutual website, Chief Executive Bruce Hemphill said the four companies that make up the group are a poor match.
In truth, when one looks closely, there is very little commonality between the businesses and limited rationale for them to be in one group. It's a costly structure with insufficient synergies to justify those costs. Additionally, regulatory change has added and will add extra complexity.
The prospect of a managed breakup has impressed the markets, with Old Mutual seeing a significant rise this week in its share price.
It does seem that they're trying to move away from just costly framework which can bog down some of the businesses. And whether or not this is an example to other businesses, it remains to be seen. But certainly it has, the market has reacted well to this news.
The details of the split will be hammered out over the next 2 years, but the company said most of its 54% share in the South African lender Nedbank would be distributed directly to Old Mutual shareholders, with the group holding a minority stake. Old Mutual deals largely in the South African rand, and the currency's weakness is said to have weighed heavily on the earnings of Old Mutual in the last year. Divided, much of the company can escape that. A sponsor of the England rugby team, there are already reports of bids from private equity firms for the company's lucrative wealth unit. The group's emerging markets arm was also a big contributor to Old Mutual's profits last year. This move by Old Mutual is very much based on the sum of the parts being greater than the whole. But after more than 270 years of business, much of it in Africa, this really is the end to a financial era dating all the way back to the very beginnings of world capitalism. Richard Bestic, CCTV, London.
Now let's take a look at some quick facts about Old Mutual, the company. It was established in 1845 in Cape Town, South Africa as a life insurance company. It has grown to serve over 17.5 million customers worldwide and employing in excess of 61,500 people. Now it manages funds in excess of 319.4 billion pounds, or just about $460 billion. It is represented in 13 countries in Africa, including Ghana, Nigeria, the Democratic Republic of Congo, South Sudan, Kenya, Uganda, Tanzania, Rwanda, Malawi, Zimbabwe, Botswana, Namibia, and of course South Africa. Now, in a lot of Central and East Africa, Old Mutual's presence follows a recent acquisition of insurance firm UAP Holdings. Now, Old Mutual is also the majority shareholder of Nedbank, one of South Africa's largest banks, besides running another 5 operations in the country, including, of course, Old Mutual Wealth and Old Mutual South Africa. Now, following Friday's announcement, Old Mutual's share price added just under 2% in the London Stock Exchange, but dropped more than 6% on the JSE, while Nedbank gave up about 3.22%. Now let's get more on the decisions behind this split, this decision by Old Mutual. We're joined now by Sumitra Nydoo in Johannesburg and of course Richard Bestic in London. Welcome to the show. And Richard, I'd like to start with you. Now, Old Mutual pointed to regulatory changes in the UK and of course South Africa. Just a few weeks later, we heard Barclays made a similar move. What exactly are these regulations and how, of course, are they changing the way business is done?
Well, the new regulatory measures Old Mutual was referring to date back to the financial crisis, the financial crash in 2008. It was lax regulation then that was blamed for the entire system tipping over, domino style. So in an attempt to prevent it happening again, central banks and governments have been bringing in new rules to rein in the wilder aspects of banking, effectively imposing stress tests to ensure they had enough capital to see their way safely through another crisis and to ensure they pull back from their riskier practices. For the banks and other financial institutions like Old Mutual, that of course has had cost consequences. You mentioned Barclays Bank there pulling out of Africa. It had a majority share in Barclays Africa, but was required to have capital backing for the entire operation. Now that, combined with low earnings from Barclays Africa and a deflated rand, meant that it was easier and cheaper to quit the entire continent than to meet the demands of the new regulatory environment. The same applies, of course, to Old Mutual. The new regulatory environment means it's more profitable to break up and running costs can be cut. It also means large sections of the business can be protected from that ailing South African currency we were talking about.
Well, Sumitra, the company actually says it plans to spin off its controlling stake in Nedbank. Now, this is the second bank we've seen leaving South Africa's banking space. What are they running away from? And of course, more importantly, what is the outlook for banks like Nedbank now?
Yes, well, by the close, the share price was down almost 4% on the day. And that seems to be as a result of some nervousness. Nedbank and Old Mutual have a very long history together, but Nedbank ran into problems several times over the years, and Old Mutual has had to bail the bank out, and this is how it eventually became a majority shareholder. So now there's a bit of concern that in case something goes wrong in the future, there will be no big backer providing that safety net. The sharp decline in the rand has played a role as well. So while Nedbank is now performing very well and contributed significantly to the Old Mutual Group's earnings, that was wilted down just as significantly because of the poor exchange rate as the group reports in pounds. And of course, the fact that we now have two big international groups spinning off operations in South Africa, as you say, is not great in terms of confidence. But having said that, the rand today strengthened on the day as overall, the move is really being put down to the new EU regulations that's making it really difficult for these big groups.
Now, Richard, this split is actually expected to increase value for Old Mutual's investors. Now, what has been the UK investors' response to this news, including, of course, the distribution of Nedbank shares to the shareholders there?
Well, the markets here in London, at least, appear very happy with the new situation. The share prices on the London Stock Exchange were up on early trading, as indeed they have been all week, on rumours that this was going to happen. In specific terms, though, we're at an early stage with this breakup. It's the culmination of a strategic review going back to last November and will only reach completion by 2018. So as for Nedbank, well, shares in Joburg have slipped, and there could be some dissatisfaction among shareholders who don't necessarily want to hold shares in Nedbank. However, the actual terms of the breakup and sale of the four companies will be key as and when they are finalised.
Well, Sumitra, I mean, I'm very curious about how Old Mutual's split will impact its East Africa operations. Here in Kenya, we know the company acquired UAP Insurance and, of course, the microfinance institution, Faulu Kenya. Now, how will these companies be affected by this sale?
Well, Old Mutual says they won't be affected at all at this stage, but of course they were also very thin on the detail today. We're expecting to get a lot more of that detail in the coming months. So as we understand it, the group will be split into four businesses, one of which is the Old Mutual Emerging Markets business. The Africa operations will fit into that business. Now, Old Mutual said today that it's very pleased with its operations in Africa, and in particular the new acquisitions it's made in recent years. The financial director, Ian Williamson, was especially upbeat on the Kenya acquisitions, saying there's still room for more growth in the region. Old Mutual signed up 1 million new customers in Africa over the past year, and that figure is expected to rise considerably in the next 2 years.
Well, thank you both so much for those insights. Of course, Sumitra Nydoo joining us in Johannesburg and Richard Bestic in London.